Hello students, welcome to Mr. TK classes. Today we are doing the statement of financial position. So we are doing question 2 from FAC 1601 May or June 2019 UNISA question paper. The question reads, Bamboo Furniture Clothes Corporation is a retailer of furniture made from bamboo tree. For every 10,000 worth of sales, the corporation donates furniture to the amount of 1,000 to nursery schools in the informal settlements. Mr. Dlamini and Mr. Zulu are the only members of the corporation with a 60% and 40% interest in the corporation respectively. The members provided you with the following information of the corporation to enable you as the accounting officer to compile the annual financial statements for the year ended 30 June 2018. Extract of balances as at 30 June 2018, members' contributions, and all this information, additional information required. A. Prepare the statement of changes in net investments of members of Bamboo Furniture Clothes Corporation for the year ended 30 June 2018. Prepare the statement of financial position of Bamboo Furniture Clothes Corporation as at 30 June 2018. All right, so we are going to do our answers here, part A and part B. We are going to do our statement of changes in net investments here. And this is our financial year. If we are looking at our requirements, we are going to see that our year is ending 30 June 2018. And if you also look at this extract, you can see that our year is ending 30 June 2018. So if our year is ending 30 June 2018, it means our year started 1 July 2017. So our statement of changes in net investments, we should have members' contributions, retained earnings, loans from member, loans to member in our total column. So we are going to have balances at the beginning. So this is balances at 1 July, balances at 1 July 2017, right? We are going to have balances at 1 July 2017. Then we are going to have our comprehensive income for the year. Comprehensive income for the year. Comprehensive income for the year. We are also going to have distributions to members. Distribution to members. We are going to have loan to or from members, right? We are going to have balances. We are going to have balances. We are going to have balances. Balances. We are going to have balances at 30 June. Balances at 30 June 2018, which is the end of our financial year. All right. So now let us go through our information, and we use our information to answer this. All right. So balances at the beginning, members' contributions. All right, you can see we have members' contributions here, 120,000 and 80,000. But are these balances at the beginning? Let us see. We can see that here there is no debt written here, which means that these members' contributions are as at 30 June 2018. So we are going to write them here. What are the amounts? The amounts, we are going to say 120,000 plus 80,000. We are going to get 200,000. 200,000. Then now let us check if there are any changes that happened during the year. We will be checking in our additional information. All right. We can see that there are no changes which happened during the year. So it means that our members' contributions started as 200,000 because there are no changes which happened during the year. All right. So we move on to our retained earnings. we need balance. We need our balance at 1 July 2017. All right, so we are going to say retained earnings 1 July 2017, 160,000. 160,000. All right, then we want our comprehensive income for the year. We can see that we have profit before tax, before any adjustments in respect to additional information. So it means we need to adjust this 180,000. So for now, let us just leave our retained earnings and do the other ones. They look easier, then we will do our retained earnings as the last one. All right, loans from member. Loans from member. We have loan from member Lamini, 50,000. But this 50,000, there is no debt here, right? Which means that the debt is this one. So the debt is 30 June 2018. So we are going to say loan from member. How much is it? 50,000. Loan from member, 50,000. So we are going to write our 50,000 here. Now let us go to our additional information and see if this 50,000 is supposed to be at the end. Let us go to our additional information. During the previous financial year, the corporation experienced cash flow problems. In order to rectify the situation, on 1 January 2017, Mr. Lamini made a loan advance amounting to 30,000 to the corporation. All right, when? On 1 January 2017, right? Yeah, on 1 January 2017. When is our year? When did our year start? Our year started 1 July 2017. So it means this was before the beginning of our financial year. All right. The loan agreement stipulates that the loan bears interest at 8% per annum. The interest on this loan is capitalized at the end of each financial year. What does this mean? It means that whenever you calculate loan interest, you have to add it back to the loan. It increases our loan amount because Mr. Lamin will be saying, all right, the loan is being capitalized, so you don't have to pay the interest on loan. That interest on loan, you just have to keep it, and it's supposed to increase the loan amount, right? So we are going to say, okay, let us just go on. On 1 July 2017, Mr. Dlamini increased his loan to the corporation. The terms and conditions of the loan remained unchanged. The interest for the current financial year must still be provided for. So if you look at the dates that we are given here, let us just break down these dates. On 1 January, on 1 January 2017, which was before the beginning of our financial year, the business acquired a loan from Mr. Lamini, right? Okay, the loan was 30,000. The loan was 30,000 at this point. The loan was 30,000. So now, interest on loan is capitalized. And now we are seeing that on 1 July 2017, which is the beginning of our financial year, Mr. Lamin increased this loan, right? Increased his loan to the corporation. It is here. All right. So the terms and conditions of the loan remained unchanged, which means that interest is still being capitalized. So from this date, Mr. Lamini never increased the loan, or we never paid back the loan. So it means that from this amount that we should be having here from Mr. Lamini is the same amount that you will be having on 30 June here, 30 June 2018. But the only difference that is going to come here is the interest on loan. Is the interest on loan that is going to be added back. But this interest on loan that is going to be added back, what are they saying about it? The interest for the current financial year must still be provided for, which means that this interest was not added. And we are seeing an amount that we are given here, which is 50. We are seeing an amount that we are given there, which is 50,000. Right? Which is 50,000. We are seeing the amount that we are given here, which is 50,000, this one. And there's an interest which was supposed to be added, which was not added, which means that this amount was also 50,000. This amount was also 50,000. This amount was also 50,000. So let us write here 50,000 and remove this 50,000 because there's an interest on loan which was supposed to be added here, which was not added. Let us calculate that interest on loan. Remember, we are calculating at 8%. So we are going to say 8% of 8% of 50,000. Right? We are going to get 4,000. We are going to get 4,000. So this 4,000 is this amount that was supposed to be here. 4,000. And it means that our balance at the end was going to be 54,000. Right? Was going to be 54,000. Our balance at the end that is written in here of 50,000 is wrong. Why? Because it was not adjusted with this interest that we have just used to adjust that amount now. All right. So now we are done with this loan from member. Loan to member, Mr. Zulu, loan to member, Mr. Zulu, 30,000. And there's no debt as well, which means that the debt that we are using for this line item, it is this one, 30 June 2018. That's why we also come here and write here on 30 June 2018. Now let us see what the information is saying. On 1 September 2017, Bamboo Furniture Close Corporation lent 30,000 to Mr. Zulu. The loan bears interest of 14% per annum, payable in cash at the end of the financial year. The capital portion of the loan is receivable on 1 September 2018. The interest on the loan has already been taken into account. Right? The interest on loan has already been taken into account and all that. So this loan was granted to Mr. Zulu when? On 1 September 2017. And if we look at our financial year, 1 September 2017 is during our financial year. So it means at the beginning here, there was nothing. This 30,000, they are saying it was granted during the year. That's why we have it now at the end. At the beginning, there was nothing. Because if you look at our additional information, this 30,000 was granted during the year, which means at the beginning there was zero. All right. Okay. Now let us go back to this column that we said we are going to make it our last one. We need our comprehensive income for the year. So let us go to our working papers and say profit before tax. Was it profit before tax? Yes, profit before tax. Profit before tax. Let us adjust this profit before tax that we are given here. Profit before tax 180,000. We need to adjust this 180,000. We need to adjust this 180,000. All right. So under adjustment 1, there's something that we saw here. All right. They said the interest for the current financial year must still be provided for, which means that the interest on loan was not subtracted. Interest on loan was not subtracted. And our interest on loan, remember, we have already calculated it. Interest on loan, this 4,000, right? This 4,000, we have already calculated our 4,000 there. So this 4,000 should be subtract. This 4,000 should be subtracted. All right. So now let us look at any other adjustment that we have. All right. Number 2. On 1 September 2017, Bamboo Furniture Close Corporation lent 30,000 to Mr. Zulu. The loan bears interest at 14% per annum, payable in cash at the end of the financial year. The capital portion of the loan is receivable on 1 September 2018. The interest on the loan has already been taken into account. This was already taken into account, so we don't need to put it here. All right. So we are going to number 3. The investment consists of the following. The investments consist of the following: 10,000 ordinary shares in Kleinhoff Limited, purchased on 1 October 2017 for 30,000. Right? K Limited is listed on the JSE on 30 June 2018. The fair value of the shares held in K Limited was determined to be R4 per share. Right? The shares are held for speculative purposes. So, what does it mean when shares are held for speculative purposes? They are held so that when they increase in value, they will be sold, right? So they just bought these shares, these 10,000 ordinary shares, so that when they increase in value, they will sell them, or they will just recognize that income that they will be having. So now we want to see. Let me just write investments. So now we want to see whether these shares, whether they appreciated in value. We want to see whether they appreciated in value. These shares were 10,000 shares. They were 10,000 shares at how much? There were 10,000 shares at 30,000 rands. At 30,000 rands. Okay. So now, what are they saying about these shares? At the end now, because this was the buying price, they bought these shares at this much. Now, on 30 June 2018, which is the end of our financial year, the fair value of the shares held in K Limited was determined at R4 per share. All right. So if we have 10,000 shares and they are determined at R4 per share, right? It means these shares are for how much now? They are for 40,000 rands. Okay. So now we need to see the amount that they appreciated with. So these shares, they appreciated with, okay, let me just say fair value adjustment. These shares, they appreciated with, okay, 40,000 subtract 10,000, subtract 30,000, we get 10,000 rands. They appreciated with 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 10,000 rands. This is our fair value adjustment. Okay. So here, let me just indicate that this is when they were bought, because we might use this information again. This is when they were bought, and now this is at the end of our financial year. This is now at the end of our financial year. All right. This is when they were bought, and now that's the end of our financial year. All right. And now this is the fair value adjustment of 10,000. So this fair value adjustment of 10,000 was not recognized here. Let us come here and say fair value adjustment. All right. It was not recorded. This 10,000. It was not recorded. So let us add it. Okay. Then 20,000 ordinary shares in Bamboo Traders Private Limited, purchased at a total cost of 35,000. All right. Then we move on. Included in profit before tax is a payment of 15,000 to Property Holdings Limited for office rent for the period of 1 May 2018 to 31 July 2018. When is our year ending? Our year is ending 30 June 2018. And what are they saying? These shares, what are they saying about rent? What are they saying about rent? Included in the profit before tax is a payment of 15,000 to Property Holdings for office rent for the period of 1 May 2018 to 31 July 2018. So it means there was a prepayment here. there was a prepayment, prepaid rent, prepaid rent. Okay, prepaid rent. Let us calculate our prepaid rent. We are going to say the rent that was paid was for how many months? Was from May to July. So we are going to say May, June, July. Those are 3 months, right? And how many months were out of our financial year? You can see that our financial year is ending 30 June 2018, right? And we paid until 31 July 2018, which means July is out of our financial year. It is only 1 month. So we are going to say 1 month out of those 3 months multiplied by 15,000, right? We are going to get 1 divided by 3, 1 divided by 3 multiplied by 15,000, 5,000. So 5,000 for July was a payment in advance, right? 5,000 for July was a payment in advance. So we are going to say prepaid rent. Prepaid rent. How are we going to use? How are we going to adjust our profit with that 5,000? Now that's another question. So we are going to say if prepaid rent. Now let us see, is it an expense or an income? Included in profit before tax is the payment of 15,000 to for office rent. So this is an expense. An expense was paid in advance. And that advance payment was also subtracted from here, right? An expense was paid in advance. And that advance payment was also subtracted from here. What do you know about prepayments? Prepayments should not be included in the calculation of profit, right? But this 5,000 was subtracted from here. So it means that we need to reverse that. So how do we reverse? We reverse by adding that 5,000. We add it back because we are saying this rent that was paid in advance was subtracted from our profit, and we know that we don't subtract prepayments. So what we are going to do, let us add that amount back. We add that 5,000 back. All right. So what is another one? The income tax expense for the financial year ended 30 June 2018 amounted to 50,000 and must still be accounted for. All right. 50,000 income tax must still be accounted for. So we are going to say income tax. And even if you look at this one, it says profit before tax. It is because the tax was not subtracted. So now let us say our corrected comprehensive income for the year. Comprehensive income for the year. Corrected comprehensive income for the year. So we are going to say 180,000 subtract 4,000 plus 10,000 plus 5,000 subtract 50,000. We are going to get 141,000. 141,000. So this is our corrected comprehensive income for the year. All right, 141,000. So we need to take our 141,000 and put it here. All right, distributions to members. We are going to say, do we have any distributions to members here? Okay, profit distribution to members 175,000. And when we were reading the adjustments, we never saw anything that has to do with the distributions to members in the adjustments. Okay, so now we are just going to say 160,000 right? Plus 141,000, subtract 175,000. We are going to get 126,000. 126,000. All right, so here we also need to say non-current liabilities. Okay, non-current liabilities. Okay, let's just say non-current liability, and let also say current liability. Current liability. Current liability. All right, this is in respect to loan from member, because this one is a liability, this one is an asset. If you give a loan to a member, it means that's an asset. If you get a loan from a member, that's a liability. All right, so because we saw something like repayment or something of that sort. Okay. Memorandum of the loan agreement indicates that 40,000 of the total loan is repayable on 30 June 2019. And when is our year ending? 30 June 2018. So it means that from our year end, 30 June 2019 is only 1 year. So it means that that 40,000, that 40,000, that 40,000, right? That 40,000 is a current liability because it will be paid back in a year's time according to this adjustment. The memorandum of the loan agreement indicates that 40,000 of the total loan is repayable on 30 June 2019 and the remaining portion on 30 June 2020. So the remaining portion, we are going to say 54,000 subtract 40,000, right? We are going to get 14,000. 14,000 is going to be paid back in 2 years' time, right? Which is the remaining portion is going to be paid back in 2 years' time. So this one which is going to be paid back in 2 years' time is a non-current liability. This one which is going to be paid back in a year's time is a current liability. All right, so now we move on with our question. Here we are done. Now we are going to have assets here. This is our statement of financial position. So we are going to start with our assets. Okay, I just need to do this. Okay. So we start with our assets. Then we are going to say non-current assets. Non-current assets. Right? Non-current assets. Under non-current assets, we have property, plant, and equipment. Property, plant, and equipment. Okay. Property, plant, and equipment. Let us do the calculations. Okay, we just come here and say PPE. All right. So we have the non-current assets that we have. We have machinery and equipment. Machinery and equipment. Machinery and equipment. We are going to say the cost of machinery and equipment 220,000, right? 220,000. Subtract the accumulated depreciation at the end, machinery and equipment. This is at the end because this is 30 June 2018. 50,000. So we are going to subtract 50,000, right? Then what are we going to get? We are going to say 220,000 subtract 50,000. We are going to get 170,000. 170,000. Then we go to the next one. The next one is furniture and fittings. So we are going to have furniture and fittings. Furniture and fittings. So furniture and fittings, we are going to say, let us just take this to the next page. Furniture and fittings, we are going to say the cost of furniture and fittings. The cost of furniture and fittings, 143,000. So we are going to say 143,000. Subtract accumulated depreciation at the end. Okay. Accumulated depreciation, furniture and fittings, 30 June 2018. Yes, this is at the end, 30 June 2018. So that's 23,000. So we're going to say 23,000. All right, what do we get there? We are going to say 143,000 subtract 23,000. We are going to get 120,000. 120,000. All right, so now property, plant and equipment, we are simply going to say 170,000 plus 120,000. We are going to get 290,000. We are going to get 290,000. So we are going to come here and say 290,000, which is our total here, 290,000. All right. So we move on to the next one, which is current assets. Which is current assets. Current assets. So under current assets, we are going to have, under current assets, we are going to have inventory. 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 When we were reading the adjustments, we didn't say anything for inventory in the adjustments. So let us just check here. Inventory, okay, 46,000. So we are going to say 46,000. All right, then trade and other receivables. Trade and other receivables. Trade and other receivables. Trade and other receivables. Where can we find this? Trade and other receivables, 35,000. 35,000. All right. We have an adjustment there. Okay, let me just do this. Let me just open bracket, 35,000 plus, because remember we calculated the prepaid rent expense. Prepaid rent expense of 5,000. So if you pay rent in advance, that rent that we have paid in advance, that amount of 5,000 is our money because we have paid in advance. That 5,000 is our money. So we are going to take that 5,000. It is a receivable. 5,000 is a receivable. Okay. So what do we get? 35,000 plus 5,000, that's 40,000. That's 40,000. That's 40,000. All right. Then we also put our loan to member. Loan to member. Loan to member. Loan to member. Remember we did, let us see if we adjusted that amount. Loan to member 30,000, we didn't adjust it. So we are simply going to write our 30,000 here. Okay. Then investments. Investments. I remember there's some calculations that we did when it comes to investments. All right. Investments, we are going to have, remember I said at the end, it was now 40,000. Looking at this information here. When this was bought, it was 30,000. But now at the end, it was now 40,000. So we are going to say 40,000 investments. We are going to say 40,000 plus, right? We have another investment here, which is 35,000. This one didn't change, right? 35,000. So 40,000 plus 35,000. Let us just use our calculator to be sure. 40,000 plus 35,000. That's 75,000. That's 75,000. All right. Then now we are saying total assets. total assets. Okay, total assets. We need to calculate our current assets first. We are going to say 46,000 plus 40,000 plus 30,000 plus 75,000. We are going to get 191,000. 191,000. Then 191,000 plus 290,000. 481,000. 481,000. 481,000. Okay. Then we are moving to our equity and liabilities. Equity and liabilities section. All right, so we have total equity. We have total equity, which has members' contributions, which has members' contributions. Okay, so members' contributions, I remember doing it here. At the end, what do we have? 200,000. We have 200,000 at the end. Then we are going to have retained earnings. We are going to have retained earnings. So retained earnings at the end, what do we have? 126,000, right? So we are going to have 126,000. Now we are just gonna add the 200,000 plus 126,000. We are going to get 326,000. 326,000, right? Then now we move to our we just need to put this on a new page. Now we move to our liabilities section. We move to our liabilities section, right? So under liabilities, we have non-current liabilities. We have non-current liabilities. Okay. So here we are just gonna say we have long-term loan. Long-term loan. And remember, when we are writing here, we said our non-current liability is 14,000, right? Okay, we said our non-current liability is 14,000. So we are going to come here and say 14,000. And this is the only one, so we are going to have 14,000. All right, then we move on to our current liabilities. Current liabilities. So under current liabilities, we have trade and other payables. Trade and other payables. Trade and other payables. Okay. So trade and other payables. This is the amount. Trade and other payables. 37,000. Okay. Let us see if we are going to adjust this 37,000. Let me just put it on our calculator. We are going to say 37,000. 37,000. Let us see. Income received in advance. If you receive income in advance, it means that's a liability because you are having money that is not yours. Income received in advance, that's a liability. The money that you are having is not yours. So 10,000 is also a liability. So when we add the two, we are going to get 47,000. We are going to get 47,000. Okay. Let me just put this in brackets. We are going to say 37,000 plus 10,000. Okay. Then now let us I have seen a bank overdraft here. We are also going to write our bank overdraft. So our bank overdraft is 20,000. Is 20,000, right? Okay. Then remember we were saying we have something that is a current liability here, 40,000. This 40,000, 40,000 is a current portion of loan. Current portion of loan. Do we still have anything else here? Do we still have anything else? Let us check. SARS income tax. All right, 16,000. I need to explain something about SARS income tax. All right. SARS income tax. SARS income tax. This account is a liability account, right? The first thing that you should know here is that it is a liability account. It is a liability account. Okay, it is a liability account. So let me just say this is a liability. This is a liability. If you don't pay SARS what is due, means that's a liability, right? That's a liability. So it has a credit balance. It has a credit balance. Or let me just say it decreases on the debit side and increases on the credit side because it has a credit balance. It is a liabilities account. So now when they reflect it with the DR here, it means that this amount that we are having is not a liability, because remember a liability has a credit balance. So this amount that we are having is not a liability, it's an asset, which means that we should have included this amount under assets. But now let us see, because this asset that we are saying we might be having, let me just say minus, let me just say minus 16,000, right? You want to see if we still have a liability, plus if we still have an asset, because remember we have income tax for the year. So there was a tax refund of 16,000, right, which is an asset. But now we have a liability of during the year, a liability amounted to 50,000, right? During the year, a liability amounted to 50,000. So what does it mean? It means that if we say minus 16,000 plus 50,000, this is the liability that we now have, a liability of 40,000, a liability of, okay, what did we get again? 34,000, sorry, a liability of 34,000, because we're saying when we started we had a tax refund, SARS was owing us, but now now at the end of the year we are now taking into consideration the tax liability for the year, which is 50,000. It will swallow this refund, right? And we end up with a liability of 34,000. All right. So here we are going to have 34,000. We are going to have 34,000 as current tax liability. Current tax liability. Current tax liability. So we are going to say minus 16,000 plus 50,000, right? Plus 50,000, which means that if we had a credit here, if we had a credit, we're going to say plus 16,000 plus 50,000. It was going to be bigger, right? Okay. So now let us do this. 47,000 plus 20,000 plus 40,000 plus 34,000. We are going to get 141,000. Right? Then now we are going to say, because now we need this total. This total is called total equity and liability. Total equity and liabilities. Liabilities. Okay. So we are going to say 326,000. We are starting here from our equity, right? Then we add this, we add this. So we are going to say 326,000 plus 14,000 plus 141,000. We are going to get 481,000. Okay. So at the end, this should satisfy the accounting equation, which says assets, right, which have a total of 481,000 are equals to equities and liabilities, which have a total of 481,000. So 481,000 is equals to 481,000. Okay. So we are done with this question. Let us see. Yes, we are done with this question. We are done with this question. Thank you. We meet you in the next lecture. Thank you.